Try to first of all classify these assets, liability accounts, and just leave out anything that is not asset and liability. We're just focusing on current ratio and debt ratio here. So again, if after classifying, try to see if you can calculate current ratio by totaling up current asset divided by total current liability. Second ratio, total debt, total liability, total asset. Okay, from the above dollar amount, just add up all the current asset divided by current liability. See what is the ratio you get. Second one, add up the total debt divided by total asset. See what is the ratio, and if you're able to evaluate the financial position right now. But don't forget to do this weekend's homework. It's also due next Tuesday. Originally, I didn't give you homework because originally next week was midterm. But since I pushed back midterm, so next week we'll still have homework to do, and it's due Tuesday. Okay? It's on chapter 4. I erased this. Okay, now to calculate current ratio, we want to know current assets over current liabilities, debt ratio, total debt over total assets. So let's just classify the upper accounts first. Notes payable specifically tells us it's long-term liability already. So notes payable you have here $7,800. That's long-term category. Prepaid rent is a prepayment. Prepayments are assets. That falls under current asset category. Salary payable is short-term, $3,000. Have salary payable there. Service revenue doesn't apply to this. Supplies, $500 is asset. Accounts payable, short-term liability. So accounts payable, you have $3,700. Cash, depreciation expense is an expense account, so this does not apply. Equipment, long-term. Okay, so you have three current asset accounts. If you add them together, that will give you the three asset accounts, add them together, that will give you $12,000. Total current liability, you'll be adding up the $3,000 plus $3,700. That will give you $6,700. For debt ratio, total them up. Okay, so total liability, total assets. Okay, so for these two ratios, the first one here, total current asset, $12,000 divided by $6,700. It gives you 1.79. Remember, the rule of thumb here is if it exceeds 1.5, then it's considered pretty good. Right, we want to have this ratio as large as possible. That means we have enough current assets to pay off current liability. So this is a good sign. For debt ratio, $14,500 over $27,000. And the rule of thumb is about 0.6. Right? So anything below 0.6 is considered pretty well as well. It means you have enough total asset to cover total debt. So both of these ratios will tell you that the sign is pretty well in terms of financial position, paying off current liabilities and long-term liabilities. Okay, so last line here really just means for every dollar of liability, you have 1.79 current assets to cover for it. That's what the ratio means.